Welcome to our channel, where in this video we will embark on a captivating journey through the intricacies of investing via the stock market. In this fast-paced digital era where charts and numbers dominate our screens, it's no wonder that confusion can quickly set in. But fear not, for today we will demystify the structure of the stock market and bring clarity to the forefront. Imagine, if you will, a world where your entrepreneurial spirit has blossomed into a successful business venture, yet as ambitions soar and dreams of expansion or luxuries like owning a private jet emerge, the question arises, where does one find the necessary funds to fuel these aspirations? Enter our intriguing proposition, unlocking the power of the stock market. Picture this. By strategically breaking down your company and offering a portion of its ownership to eager investors while retaining majority control, you gain access to a whole new realm of financial possibilities. This transformative process is known as initial public offering, or IPO for short. It's the key that opens doors to a world brimming with opportunities. But here's the burning question. How much money can you truly make through an IPO? Well, my friends, let's take the example of Mark Zuckerberg's revolutionary brainchild, Facebook. In 2012, with much anticipation and excitement, Facebook made its grand entrance into the public market. Initially, 337 million shares were offered to eager investors at a price of $38 per share. Oh, and what a promising start it was. The prospect of owning a slice of this digital empire seemed enticing, igniting a frenzy of interest. However, as Mark Zuckerberg realized the insatiable demand for Facebook shares, he decided to seize the opportunity to add an additional 84 million shares to the mix, bringing the total to a staggering 421 million shares. With a stroke of business acumen, he astutely capitalized on the market's hunger for a piece of his digital pie. And what happened next? Well, prepare to be astonished. Every single one of those additional shares was sold, generating a staggering $16 billion in funds. In a matter of mere hours, Zuckerberg catapulted into the realm of billionaires, a testament to the immense value placed on Facebook's future prospects. But as with any roller coaster ride, the stock market is a realm of unpredictable ups and downs. While the stock price initially surged to $45 within the first day of trading, the elation was short-lived. By the end of that eventful day, the price retreated back to its original $38, reminding us that the journey had just begun. Unfortunately, the challenges did not end there. In the following weeks, Facebook stock experienced a tumultuous descent, plummeting to as low as $20. The once buoyant price was now a fraction of its initial value, marking a significant setback for investors and a sobering reminder of the inherent volatility of the stock market. To truly comprehend this roller coaster of emotions, we must delve into the essence of the stock market itself, stock ownership. Let us now delve into the realm of stock ownership and explore the dynamics of being a shareholder in a company. In the past, stocks were primarily acquired for the dividends they offered. The underlying principle is simple. When you purchase a stock, you effectively become a part owner of the company. As an owner, you have a rightful claim to a portion of the company's profits. Imagine this. In January 2017, you made a wise decision and acquired 10 stocks of Facebook, positioning yourself as a co-owner along the likes of Mark Zuckerberg himself. It's an exciting prospect, isn't it? Now let's consider the company's financial success. Suppose Facebook rakes in a staggering $15.934 billion in profits. The question arises, how much of that belongs to you? To put it in context, you initially spent $1,300 to purchase your 10 stocks at the Facebook stock price in January 2017. However, before we calculate your share, let's take a moment to examine the bigger picture. In total, there are nearly 3 billion Facebook stocks in circulation, about 2.956 billion to be precise. Considering this vast number, one might begin to question the significance of your 10 stocks. Nevertheless, let's remain optimistic. If we divide the net income by the number of shares, each stock should hypothetically earn slightly over $5, approximately $5.39 to be exact. This figure is commonly referred to as EPS, or earnings per share. In other words, your 10 stocks should theoretically earn you around $54, or about $53.90 to be precise. Not a bad return, right? However, it's crucial to recognize that this is merely a hypothetical scenario. In practice, as a small shareholder, you won't receive a direct share of the profits. The decision on how to allocate the company's earnings rests in the hands of the board of directors. Often, their priority lies in filling their own pockets and expanding the company, with minimal regard for individual shareholders like yourself. But fear not. Not every company operates in such a manner. Take Apple, for instance. Last year, they distributed a whopping $13 billion in dividends, about $12.769 billion to be exact, translating to approximately $2.50 for each stock. Admittedly, this may not seem substantial, particularly for a stock priced at $170. However, receiving something is always preferable to receiving nothing at all. In the ever-evolving landscape of stock ownership, the focus has shifted from dividend payments to the price of stock itself. What truly matters now is the potential for capital appreciation. Consider the example of Apple. Its stockholders experienced an impressive 33% gain in just 1 year, with the stock price soaring from $120 to $160. Apple's stock market journey has been nothing short of remarkable. You've probably heard that Apple became the first company to reach $1 trillion valuation when its stock price crossed $200. But here's an intriguing twist. Back in June 2014, Apple's stock price stood at a staggering $645. Does that mean the company was valued at over $3 trillion? Well, the stock market is a complex beast, and valuations are influenced by multiple factors beyond just the stock price. Determining a company's worth involves considering variables like the number of outstanding shares and market capitalization. So, while it's an intriguing thought, we can definitively say if Apple's valuation surpassed $3 trillion at that time. This brings us to our next topic on the splitting of stock at Apple. Stock splits. The concept of stock splits, a fascinating aspect of the stock market. Allow me to shed some light on this phenomenon. Stock splits occur when each existing share of a company is divided into multiple shares, resulting in a proportional decrease in the stock price. Let's consider the example of Apple to illustrate this further. In the case of Apple, a stock split was implemented, dividing each share into 7 pieces. Consequently, the stock price decreased proportionally, settling at around $92.70 per share. It's important to note that from a technical standpoint, nothing substantial changes in terms of the company's overall value or the ownership structure. The significance lies in the increased accessibility of the stock. With a lower price per share, more individuals can now afford to invest in Apple, expanding the community of Apple investors. This broader participation can bring in new perspectives, increase trading activity, and potentially larger investor base. So, as a result of the stock split, Apple's stock becomes more affordable, enticing a wider range of investors to join the ranks of Apple shareholders. It's a strategic move that aims to promote inclusivity and broaden the ownership base within the company. Warren Buffett. Let's turn our attention to the legendary Warren Buffett, a renowned figure in the world of investing. Buffett's company, Berkshire Hathaway, has taken a different approach compared to many other companies. Unlike those that opt for stock splits to increase accessibility, Berkshire Hathaway has never split its stocks. Due to this unique strategy, Berkshire Hathaway has a relatively small number of shares available in the market, currently standing at 1.68 million shares. In contrast, a behemoth like Apple boasts a staggering 5 billion shares. Consequently, the scarcity of Berkshire Hathaway shares contributes to their high price, with a single Buffett stock commanding over $300,000. Considering the substantial cost per share, it's safe to say that joining Buffett's exclusive circle of investors may remain a dream for most of us. However, Buffett has also created Class B shares to cater to a wider range of investors. These Class B shares are more affordable, priced at around $200. So, while the secret investor society may be out of reach, Buffett provides opportunities for individuals to invest in his company at a more accessible level. If you enjoyed this content and want to learn more about investing and making money, do subscribe to our channel and hit the bell icon for future updates. Thank you for watching.